You opened your brokerage app this morning and your stomach dropped. Red. Everything is red. Your portfolio is down, maybe 10%, maybe 15, maybe more. The news is screaming. Talking heads are losing their minds. Your coworker just texted you saying they already sold everything. Your uncle is sending you articles titled "Why This Time is Different." And somewhere in the back of your brain, quietly, persistently, a single thought keeps creeping in. Should I just sell? Get out now before it gets worse? I need you to stop. Right now. Step away from that button. Because what you are feeling in this moment, that overwhelming, chest-tightening, stomach-dropping urge to sell everything and run, is not a financial strategy. It is a biological response, and it is about to cost you years of wealth. I'm going to show you exactly what is happening to your brain right now, why the news is weaponizing your fear, and most importantly, the brutal math that proves that selling in a downturn is one of the most expensive mistakes a person can make. Stay with me, because by the end of this video, you're not just going to feel calmer, you're going to understand why a market crash, yes, this one, might be the single greatest wealth-building opportunity you've seen in years. Let's talk about something called the wall of worry. Here's a concept that Wall Street insiders have known for decades, but almost nobody talks about on personal finance YouTube. The stock market does not go up when everything is fine. It climbs while everyone is terrified. Think about every single major market panic in your lifetime. The dot-com bubble, 9/11, the 2008 financial crisis, COVID crashing the market 40% in 3 weeks. You know what happened every single time? The market recovered. Then it hit new all-time highs. Every single time. The market doesn't climb because the world gets perfect. It climbs over a wall of worry, over wars, over inflation, over political chaos, over pandemics. And right now you are standing at the base of another wall. The question is, are you going to let fear glue your feet to the ground, or are you going to understand what is actually happening? Let's get into it. I need to be honest with you about something. Your brain is broke. Not financially broke. I mean, your brain is fundamentally, biologically hardwired to be a terrible investor. And this isn't an insult. This is science. Here's what's happening inside your skull right now. When you open your brokerage app and see that your portfolio is down 15%, your brain doesn't process that as a financial data point. Your brain processes that as a physical threat. Seriously, neuroscientists have studied this. The same region of your brain, the amygdala, that fires when you see a predator coming at you, fires when you see your net worth dropping in real time. Your body physically releases cortisol and adrenaline. Your heart rate goes up, your palms sweat, your rational, long-term thinking shuts down, and your ancient survival-wired brain takes over with one singular mission: make the pain stop. Now. And how do you make the pain stop? You sell, you liquidate, you cash out, you get to the safety of the sideline, and for one brief, glorious moment, you feel relief. The anxiety lifts, the dread disappears. You tell yourself, at least I still have something left. At least I protected what I had. But here's the brutal truth. You didn't protect anything. You just converted a paper loss into a permanent locked-in loss, and you made it at the absolute worst possible time, at the bottom, which is exactly when you were supposed to be buying. This is what I call the middle-class mistake. It's not a lack of income. It's not a lack of opportunity. It's selling your best assets at a massive discount just to get 30 seconds of emotional relief. And here's the thing that makes it even worse. The media knows this about you. Your emotional panic is not a side effect of financial news. It is the product. Think about how financial news media makes money. They sell advertising. Advertisers pay based on views, clicks, and time on site. Fear drives more engagement than calm. A headline that says, "Market down 3%, long-term investors should stay the course," gets 12 clicks. A headline that says, "Market bloodbath, is your retirement wiped out?" gets 12 million clicks. Every red ticker, every breaking news chyron, every screaming pundit, they are not informing you. They are harvesting your attention by exploiting your biological fear response, and they are getting paid every single time you click. Your panic, your anxiety, your 2 a.m. doom scrolling through market crash predictions, that is the product they're selling. So the first step to protecting your portfolio, recognize you are being manipulated and shut it off. Let's talk numbers, because feelings are subjective, but math is ruthless. Let's say you have a $100,000 portfolio. The market drops 20%, your portfolio is now worth $80,000. The pain is real, the anxiety is overwhelming. So you sell, you sit on $80,000 in cash. You tell yourself, I'll wait for things to calm down. I'll buy back in when it stabilizes. Here's what happens next. The market bounces back. Not slowly, not gently. Markets don't telegraph their bottoms with a polite announcement. Some of the most violent, explosive single-day gains in stock market history happen within 2 weeks of the biggest crashes. Let me say that again. The biggest up days happen right next to the biggest down days. Here's the data that most financial advisors won't show you. If you had invested $100,000 in the S&P 500 and held for 20 years, through every crash, every recession, every panic, your portfolio would be worth roughly $700,000. Now, what if you panic sold during the downturns and missed just the 10 best single days over that 20-year stretch? Your portfolio would be worth roughly $320,000. You cut your returns in half by missing 10 days. 10 days out of 7,300. That is the cost of panic selling. It's not a vague, theoretical downside. It is a quantifiable, dollar-for-dollar destruction of generational wealth. And it gets worse, because when you sell at the bottom and miss that initial explosive recovery bounce, you are now psychologically stuck. The market has gone up from where you sold, which means if you buy back in now, you're buying higher than you sold. So you wait. You wait for the dip that never comes, or you panic buy back in at the top just in time for the next correction. This is the cycle that keeps middle-class investors permanently behind. Buy high, panic sell low, miss the recovery, buy high again. Repeat. Here's the part the financial industry doesn't want you to know. The solution isn't a fancy managed fund. It's not a structured product. It isn't a complex hedging strategy that comes with a 1.5% annual fee. The boring, unspexy, statistically dominant strategy is this. Buy broad, low-cost index funds. Hold them. Don't touch them. That's it. That is what the data says. Decades of research by Nobel Prize-winning economists confirms it. The average actively managed fund underperforms the market over a 10-year period. The solution was never complicated. The enemy was always the same. You, your emotions, your panic. I want you to contrast two things. What the average person does during a market pullback and what the wealthy do. The average person sees a red market and feels dread. They see their net worth shrinking and they want it to stop. So they sell. They go to cash. They sit on the sidelines. They turn paper losses into permanent ones. They miss the recovery. They destroy their compound growth curve. The wealthy, they see a red market and they feel something completely different. They feel opportunity. When assets are down 20%, they are on sale. You would not walk into a store, see your favorite item marked down 20%, and run away in terror. You would buy more of it. A market crash is the greatest wealth-building clearance sale of the decade. While amateurs are converting paper losses into permanent losses, the wealthy are deploying capital at the lowest prices they've seen in years. And this right here, is how wealth compounds. Because here is what compound growth actually looks like in real life. Every share you buy during a downturn is a seed planted at a discount. When the market recovers, and it will, those discounted shares grow back to full value. Then they keep growing beyond that. You didn't just hold through the dip, you accelerated your snowball. Because the snowball of compound growth doesn't care about your feelings. It only cares about how many assets you own at a discount when the recovery starts. The wealthy know this, which is why the wealthy get wealthier during corrections, not because they are lucky, because they are not panicking. So here is your action plan. 3 steps, right now, today. Step 1. Turn off the financial news. I'm not asking you to bury your head in the sand. I'm asking you to recognize that every minute you spend watching market panic coverage is a minute your amygdala is being exploited. The news will not help you make better financial decisions. It is specifically designed to make you worse at them. Turn it off, close the tab, mute the notifications. Step 2. Do not log into your brokerage account to check your balance. This sounds simple. It is not. Because the moment you see that number, your brain turns it back into a tiger. The cortisol spikes again. The fear comes back. The urge to sell returns. Your portfolio is built for years, decades, generations. Checking it daily during a correction is like watching bread bake and yanking it out of the oven every 5 minutes because it doesn't look done yet. Stop opening the oven. Step 3. Automate your investments. Set up automatic contributions to your index funds on a schedule, monthly, bi-weekly, whatever you can manage. This is called dollar cost averaging. And here's the psychological beauty of it. When you automate, you remove your emotional brain from the equation entirely. The market goes down, your automatic investment buys more shares at a lower price. You didn't have to decide to buy the dip. Your system did it for you. While your emotional brain was spiraling, your automated system was calmly loading up on discounted assets. That is how you make panic selling structurally impossible. Look, I want to leave you with this. Real wealth, lasting, generational, sustainable wealth, is not built by obsessively monitoring your portfolio every hour. It is not built by trying to outsmart every market move. Real wealth is built by not burning out on the emotional roller coaster of day-to-day market noise. It's built by understanding that volatility is not a bug in the system. Volatility is the price of admission for the extraordinary long-term returns the stock market has delivered for over a century. The market's job is to scare you to sell. Your job is to not let it. The people who will build real wealth from this moment, they're not the smartest. They're not the ones with the highest incomes. They're the ones who stayed calm when everyone else was screaming. They climbed the wall of worry. They let their snowball keep rolling. And they woke up a decade from now, not having watched every red day and every green day, but simply having stayed in the game. If this video helped you step back from the ledge today, do me a favor, hit that subscribe button. Share this with someone who is panicking right now and needs to hear it, and drop a comment below. Tell me, what's your strategy right now? Are you holding? Are you investing more? Or are you still on the fence? Let's talk about it. Because this community is not built on panic. It's built on patience, strategy, and compound growth. Stay the course. I'll see you in the next one.